Good morning, everyone, and welcome to the kickoff session for season 4 of the PMA-CIBC Summit Series. Thank you to everyone in the audience today and in the industry for such strong support to keep our program fresh with new topics. And here we are at season 4, so thank you for that. Before we get started with our program, we acknowledge that the land we are meeting on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse nations, Inuit and Métis. We acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. We're also grateful to have the opportunity to work on this land, and by doing so, we give our respect to its first inhabitants. And because our audience is national this morning, if you are joining us from outside of the Toronto area, I encourage you to learn more about the traditional territories where you live, learn, and work. So welcome, my name is Chris Markovic, and on behalf of PMA Breather, CIBC, our title sponsor, and McEwitt, our media sponsor, we're also thrilled to have you join us this morning. Today, we have a very special program with Ben Tall with us, the Deputy Chief Economist from CIBC Capital Markets. And we're very grateful, as always, to have Ben share some of his insights with us. So thanks very much. Before we get started, I'm going to introduce Andy, who will start us off with an overview of where we are today in the market, and then we'll bring in Ben. So Andy, over to you.
Thank you so much, Chris. Great to be with you all this morning. Here we are in this era of probably in the next several months, the worst news you're going to hear almost on a daily basis. Comparables will be taken to the spring of 22. The peak of our market was February of last year, 1 year ago now, and those comparisons will be made by the media on a regular basis. So you're going to be bombarded over the next several months with continuing, generally pretty ugly stories from around our real estate marketplace. So I'm going to take a little different tack and talk about good news only before I pass it over to Ben, who will tell you the real story. On the good news side, rates only went up a quarter point at the last session of the Bank of Canada's review. That takes us in a period to 4.5%. Now that's up 8 times from last spring, a year ago. And but that signal and the actual words used of a pause is a very positive good news story. Also, for the first time, was a background notation from the Bank of Canada. It was actually directed by the International Monetary Fund to actually give a background story on their decision making, and so they did release a press item on how they arrived at this time, and there had been some discussion internally about not moving at all in January. So this quarter point move is kind of a light at the end of the tunnel, the sense of pause, the sense of stability. Stability for us in our business on the real estate side and the new housing business is absolutely critical. Stability of rates, stability of absorption. The consumer will react to stability with a consistent response as opposed to the variances we've been experiencing, and as a result, you get a pullback in action, and the consumer kind of sits on the sideline, as does the industry itself, waiting to see where the next signal of regrowth or repositioning is, and that's where we're at right now. We expect we're going to see interest rates remain probably in this 5 to 5.5% mortgage rate level, and although and Ben might react to this a little bit, we're in an inverted bond yield curve at the moment, where the short-term rates are higher than long-term rates. This has typically, historically, been an indication of recession. Be a good thing to hear from Ben about that, his interpretation. But it also is showing some relief on long-term bond yields, which is a predicator of lower rates going forward. So I think our sense is that through this first half, second half year, that by the second half, we've got a period that's been very, very stable, and absorptions will remain stable. Interest rates will remain reasonably stable, and that's a good thing, and that through the balance of this year, it'll slowly begin to recover. The other good news, although OSFI's stress test, the MQR, is still in place, it's actually formally under review. So Ministry of Finance, together with OSFI, is putting this under review. And I just might add, if you might want to put on the screen, Leanne, the link to OSFI's review through till April. Please pay attention to that. We'll provide you with that at either the end of this program or right now. But that link is asking for commentary to OSFI on all the items that they're actually going through. So please make the effort and take the time to send them a note from you, from your business and your experience. But it is under review, which is a good thing. It'll take a couple of months. Also, the Foreign Buyers Act regulations are under review. There was a strenuous effort made by Build, Dave Wilkes in particular, with a team who went at the regulations, which only came out December 21st and had some very draconian implications, particularly on rental production or purpose-built rental, on REITs, on the purchase of land by companies that are sitting here already active, very prominent professional organizations with foreign capital invested in their corporation, which suddenly pulled them right out of the marketplace. This is just not acceptable, and hopefully we'll see some change there. Also, the student rules, that limitation of $500,000 was, I guess, going to U of T, they could commute from North Bay. But at any rate, those are under review, which is good news, and that'll happen any moment. On the market itself, 6 months of resale stability. This is quite interesting. Both price and volume have remained reasonably flat since July, August of last year for nearly a 6-month period. This is really good. This is this holding of that price point. We've not seen further deterioration, modest deterioration or correction on pricing. And we think there's going to be a little more through Q1, Q2, but just 2 or 3 percentage points. From the peak of February last year, the great bad news you're going to hear is, of course, a correction of almost 22%. It'll probably sneak off to around 25. And this varies by region, so be very careful with that. It's slightly more in other areas, significantly less in others, and by product type. Condo high-rise didn't move nearly as much. Overall volume was 75,000 units at year end. That's off by the 10-year average is around 95,000. Of course, it's dramatically off from a year ago. And but it's still remarkable that it held, certainly in these last 6 months, at around 5,000 unit sales a month. The normal would be about 8. So it's running at 65% of absorption levels, which are quite amazing given the jump up in interest rates. Supply sitting at 9,300 units. That's off from 15,000 last July. That's kept the stability of price probably as tight as it has been, this very tight supply on resale. And that's going to continue through the spring until we reach summer period, where it'll climb back up probably in the 12,000, 13,000 range, still well below a market of balance. And the sales volume looks like it will continue. It was reasonably predictable in January, and very similar to December, and probably will bounce back up into the 5,000 to 6,000 range per month. And we'll see a year end that'll be very much like 2022, around 75,000, but more stable, more predictable, more with a slightly rising price point by year end. So we don't think we're going to see a continuing deterioration of price. In terms of the new house market, what we've had is 25,000 unit gross absorption in 2022, 80% high rise. The low rise market collapsed in February, March, and has remained very dormant. These are the lowest levels of absorption on a gross basis since really the financial recession in 2008. And it's, I've got to go back to 1996 in a recovery period of a previous major recession, or into the middle 80s before we see these kind of numbers in the low 20s as a total. We expect it's a first half, second half year. High rise is going to continue to do and perform particularly well. It's at a position where, in fact, it is surprising the performance. It's very good value. In this 1,200 to 1,400 a foot range is where, depending upon neighborhood, where it's been moving quite well. and on new launches. There's been very few of them, but depending upon the competitive position, high rise is actually doing reasonably well in this market, and low rise is struggling. And we've seen some leading edge early adopters from Opus and Deco from DeGasper's family, from Mattamy and Treasure Hill, and a few others who have attacked the market with some very aggressive pricing and done extremely well. So it's there, it's coming. It's going to take several months for the overall market to begin to adapt. And frankly, we don't see it happening until really probably the fall, summer, fall of relaunch or repositioning. The things to watch for, the impact of assignments within the high-rise market. It's about 3,000 units in our quick calculation. That's the same as there is inventory in the resale market in total. It's about 3,000 units of condo. And the new house inventory is of condo is nearly 11,000. So there's essentially some significant supply available, and you're seeing anything that's inventory effectively with some significant discounts through incentive packaging and new openings at very sensitive pricing. But moving, product is moving. Closings are okay. There's not been an issue with closings, and there are a lot to come in 2023, in excess of 30,000, but closings are okay. Delays, yes. Some singular negotiations one-on-one with purchasers, yes. But for the most part, closings are happening without an issue. Low rise is a little different. That's a little more challenging. And in fact, on the low rise market, you're probably going to see some issues facing the closing issues as we go into the year from a year ago. That again won't show its face until later summer or fall. So the marketplace in itself is actually in really quite remarkable shape for a recovery. Stable prices on resale, stable absorption, stable interest rates in a marketplace both for new and resale. The qualifying rate at 2 points above is hurting us, and that's been a real challenge. But we're at a position where we can find recovery, and we have to wait for kind of a signal in that market. With that, I'm going to conclude and welcome Benjamin Tall if he's available. We were just waiting for him to jump on board. There he is, Deputy Chief Economist of CIBC Capital Markets. Benjamin, great to have you with us this morning. I'm going to turn it right over to you.
A pleasure. And I basically agree with everything you say and more. I think that what we are witnessing here is a market that is surprising actually on the upside. What I mean by that is that given the huge increase in interest rates, we have to realize that the market is behaving okay. Yes, the low rise is struggling, no surprise because of affordability. The condo market is actually doing better than expected, and I think will surprise on the upside. So this is a market that is resilient relative to other episodes in which we have seen such a significant increase in interest rates, suggesting that the fundamentals are still very, very strong. Of course, those fundamentals are important, but what's important is also where interest rates are going, how quickly they will be going down, and what, of course, is happening with inflation. So let's start with inflation because that's really the topic. Where are we going with inflation? So we have seen a situation in which until very recently, a few months ago, the number one force of inflation was supply, namely supply chain, China. And the issue with supply is that if you're the Bank of Canada, you can raise interest rates to the sky. That doesn't mean that you can do anything about it. You know, Putin does not care about the Bank of Canada raising interest rates. So as long as you have supply issues, the Bank of Canada is impotent in its ability to deal with the situation. The good news is that the supply contribution to inflation is going down dramatically because supply chain is improving. The index of supply chain headache, if you wish, by the New York Fed suggests that things are almost back to normal, shipping costs back to normal, shipping activity back to normal. Today, you have 20% more truck drivers in the US and Canada relative to before the recession. So things are moving in the right direction. Now, why is it important? Because every time that you see a decline in the contribution of supply inflation, it means that more and more is domestically oriented, which means that the Bank of Canada is more powerful in its ability to deal with the situation because it's more effective, because it's impacting domestic forces. That's important to understand. So actually, that's a very welcome development. So the move from 6-7% inflation to about 4% inflation can be like that. Basically, a lot of it will be good prices that are now under pressure, and that's a good thing. The challenge is to move from 4.5% to 2%, which is the target. That's service inflation. And here we have some good news when it comes to the US, and that's very important for you to understand, because what's impacting the 5-year rate here is the 5-year rate in the US. So we have to understand where the bond market in the US is going in order to see what will happen to mortgage rates here. And here we have to realize that in the US, 40% of core inflation is one item, which is rent. 40%. And the rent is rising by 8% in the US, which means that if all other prices were zero, core CPI will still be 3.8%, just because of rent. That's the bad news. The good news is that the flow of new rent, namely new leases, are now running zero inflation. So the stock is 8%, the flow is zero. Every day that passes, more of the flow comes to the stock, which means that we know for sure, it's not a prediction. We know that the rent inflation in the US will go down over the next 6 months to basically be consistent with the flow of new leases that is basically zero inflation. This means that we will see a significant portion of US inflation going down, and that's something that the Fed is counting in. Canada, we are measuring housing inflation differently. In the US, it's all about rent. For renters and even home buyers, they basically pretend that they rent the house to themselves, and that's the price, and that's how they calculate housing inflation. In Canada, it's more interest payments, real estate commission, and we know that interest payments are rising. So ironically, what's happening in Canada is that the Bank of Canada is raising interest rates to slow down inflation, but one component of this, interest payments, is actually contributing to inflation more and more. And that's one of the reasons why they are about to stop raising interest rates, and we'll discuss it in a second. So that's the story regarding inflation. It's becoming more and more sensitive to higher interest rates, which is a good thing. Now, it's a bit sticky. Service inflation is a tricky situation because we have two things happening that are sabotaging the Bank of Canada, actually three. One is the government is spending. 1.3% of GDP, government spending, new spending, especially to fight inflation. So you have basically the government is spending, the Bank of Canada is raising interest rates to slow down the economy. It's like putting a humidifier and a dehumidifier in the same room and let them go at each other. That's something that is not helping. That's one thing. The other is that the consumer is still relatively strong. Remember, in the past, we discussed the $350 billion of excess savings that is sitting on the sidelines. That's something that is providing a buffer and allowing the consumer to spend despite the fact that interest rates are rising. And the job market is very tight. Again, so all those forces are limiting the ability of the Bank of Canada to fight the domestic inflation, and that's why it's so sticky. And that will continue to be the case for a while, and that's why they are basically going to keep interest rates high for longer. Now, the job market is much stronger than expected. Over the past 2 months, the market expected that the economy will generate roughly 20,000 new jobs. We got roughly 200,000 new jobs, 10 times more than expected. So the job market is very, very strong. Some of it is seasonal, some of it is all kinds of technical reasons, but overall the job market is tight. And that's the risk, because the Bank of Canada gave us a conditional commitment that they will not raise interest rates again. However, the market is now pricing in another 25 basis points by the Bank of Canada, following the very strong employment numbers. When I communicate with the Bank of Canada, I tell them to stop now. In fact, they are already overshooting. I think that we should have stopped at about 4.25. 4.5, we are overshooting. 4.75, for sure overshooting. And I think that they know that, but the issue is that inflation is a lagging indicator, and it's very difficult to have the guts to stop raising interest rates when inflation is still elevated and you get those job numbers rising very strongly. So they're in a very difficult position. At this point, I will give, unfortunately, 50% probability for another 25 move. I hope that I'm wrong with this one. I really don't want them to move. I think that our call is that they will not move. Our call that the next job market numbers will not be as strong, and that will ease the pressure. Inflation will start showing some downward trend. On a month-over-month basis, clearly the numbers are good. So I think there is no reason to raise interest rates. It's 50-50 at this point, but we are very close to the end, or maybe at the end. The 5-year rate is behaving a bit differently, because the 5-year rate went down a little bit. because of the fact that people assume that the Bank of Canada will start cutting interest rates in the second half of the year. Now, after the job numbers, people assume nothing will happen in 2023. The first move, as I suggested in a forecast before, will be early 2024. So the Bank of Canada will keep interest rates at this level or a bit higher for a year before they start cutting interest rates. And when they cut interest rates, the question is by how much? We started this madness at 1.75. We go to 4.5. Let's hope it's not go to 4.75. You study for a year, you cut to what? 3. About double what it was before, because we have about 4 inflationary forces cooking. We have just in case inventories replacing just-in-time inventories, that's inflationary. We have deglobalization replacing globalization, that's inflationary. We have all those green initiatives that are, let's face it, inflationary. And the job market is much tighter, will remain tighter because of demographics, that's inflationary. So you have 4 inflationary forces. The target will remain 2%, they're not going to change it. I know the way of thinking, the Bank of Canada, I'm telling you, they're not going to change the target. So the target is 2%, 4 inflationary forces cooking. By definition, interest rates have to be higher. How high? 3% compared to 1.75, almost double. Let me remind you that this housing market can do extremely well in an environment of a 3% Bank of Canada rate. That will not prevent the Bank of Canada from doing that, and that will not prevent the market from doing extremely well given the tight conditions in this kind of a environment. What we need is stability. What we need is to know that interest rates are not rising on a daily basis. And that's something that we'll be achieving in the second half of 2023 and clearly 2024 when they will start going down towards 3%. That's really extremely important as far as the housing market is concerned. So the Bank of Canada, I hope is done, maybe not, but we are very close to the end. The 5-year rate will stabilize and in fact will start going down, in my opinion, dancing to the tune of inflation, which I think will surprise on the downside. The housing market, as you suggested, is very resilient. The low rise is struggling for sure, and that's something that will continue to be the case, and no surprise because of affordability. The condo market, developers are starting to test the waters now. We see more and more people testing the waters, see what they can get in this environment, and they're actually surprised. But mostly, those are very good projects, very good location, so they are doing well. The others are still waiting. That will come, so I'm not too concerned about it. I had a dinner with Mr. Ford last night with some other players in the market. The government is definitely getting it when it comes to supply. They're doing a lot of things. We're talking about all kinds of options to continue to elevate purpose-built rental in terms of incentives to developers, HST, development charges, and other things that are now being discussed. Of course, we need the federal government for that. We need municipalities, but there is a push towards a coordinated effort to make sure that we are moving in the right direction. The supply story is very interesting. Usually, this is the first correction that supply is actually going down. Usually in a correction, supply goes up, and that's actually making the situation worse in terms of prices. Now prices are protected due to lack of supply. People are not selling. Totally agree that come spring, summer, the supply will rise. I will not be surprised if we will see some forced sales. It's already happening to an extent, and then a situation in which people are in a trigger rate situation where they are in variable rate mortgages, all their payments are interest payments, and they are a little bit stretched. They have to sell, so they're selling. It's a very small part. We estimate about 5 to 6% of people that are in the trigger rate situation are now selling. That's adding to supply, but this is a very small portion, clearly very, very different than what we have seen in different corrections, suggesting that this market is still very, very resilient. I don't think that we're going to see any recovery until the second half of the year. I think that the next few months will be a test. I think that prices might still go down a little bit, although the rate at which they are going down is now stabilizing. So I think that the worst is almost over when it comes to prices. Clearly, sales are stabilizing at a relatively low level. All this will improve in the second half of the year and clearly into 2024 when interest rates start to rise, it starts falling. So and of course, we know that the lack of supply, namely developments being postponed and canceled, will have a major impact 2 or 3 years from now when the demand is there. I estimate that in 2022, Canada welcomed no less than 950,000 people. Those are new immigrants, non-permanent residents, students, and people from the Ukraine on a 3-year visa. This year, I estimate it will be 1 million. None of them is carrying their house on their back. And there is a significant difference between all those new immigrants coming in terms of demand for real estate. Because in 2021, 70% of new immigrants, as I told you in the past, arrived from Canada because there were foreign students already in Canada. So the 405,000 new immigrants that we got in 2021 did not represent new demand for real estate because they were already here. In 2022, this number went from 70% to 40%. So the increase in immigration in 2022 was actually stronger in terms of the demand for real estate because more and more arrived from outside Canada. Same goes from 2023. So we have to realize that when you calculate the demand for real estate from new immigrants, you have to distinguish whether or not they came from Canada or not, namely a change of address or a change of status. And more, it's a change of address, namely people are coming from outside, introducing new demand. The supply will not be there. You don't have to be an economist to predict what will happen a year or 2 years from now. But still, we have to go through the next 6 months before we are there. OSFI, unfortunately, I'm not very optimistic. I speak to them, it just doesn't make sense to me. You really penalize first-time home buyers because if you have an existing mortgage and you stay with your bank, you don't have to go through the test. So you basically discriminate first-time home buyers at this point. That's a wrong policy. We were very vocal about it. We're still vocal about it. But reading their body language, I'm not extremely optimistic, unfortunately, I had to say. So that's the story. So all of this, I think that overall, the market is relatively resilient. If you told me that interest rates will be rising from 1% to 5.5% like that, I will tell you the damage to the housing market will be much more significant than what we are seeing now. So this tells you the fundamentals are so strong, even under the weight of this kind of increase in interest rates. I will stop here.
Ben, thank you. That's just outstanding overview. A couple of points. One is we've seen much projection and discussion about the potential for recession. Yet here we saw 150,000 new jobs created. We've seen this stability, as I pointed out, in the resale absorption. And in the new condo market has been quite surprising, as you point out. So this resiliency is quite remarkable. Do you see recession on the horizon, or have we dodged that, or is it still there given where the Bank of Canada position is?
Yeah. So not all recessions are created equal. Yeah. So what is a recession? According to some, basically the media, recession is 2 consecutive quarters of negative growth. You can get it easily. Maybe we are already in one, who knows? But I couldn't care less. As long as the job market is strong, I call it a wannabe recession. That's not a real recession. As long as the unemployment rate is stable, not rising in any significant way, in my book, it's not a recession. And it will not be after they actually try to figure out whether or not it was a recession 2 years from now.
Yeah.
You need to see the unemployment rate rising dramatically. You need to see some blood in the labor market to call it a recession. The only way to get it, unfortunately, is if you overshoot. Namely, the Bank of Canada, if they take interest rates to 5.5, that will be a recession.
Right.
That would be a real old-fashioned recession. What we are seeing now is a wannabe recession,
where you'd have real job loss turnaround and job loss correction, which we're not seeing at the moment.
Absolutely. And the consumer has this $350 billion of excess cash. That's something that is protecting the labor market as well.
Much has been made about record consumer debt through 2021, 22, actually 2020 as well, as the pandemic unfolded and this kind of irrational exuberance unfolded. We the Canadians took on record levels of consumer debt. Is that partly where the Bank of Canada is trying to cool this out a little bit, and where they'll be very cautious in terms of cutting rates at all? But
So that's a good point. So a few things here. One is that one of the reasons why we believe that the Fed will go higher than the Bank of Canada is that level of debt, the effectiveness of monetary policy, because we have more debt, let's face it. It started in 2008 when the US went through the mother of all the leveraging. We haven't, because it was not our recession. We were basically second-hand smokers back then. And the point here is that you have more debt. You are more sensitive to higher interest rates. Our mortgages are 5 years, they're 30 years, again, more sensitive to higher interest rates. So what I'm telling you is that the tiny Bank of Canada is more powerful than the mighty Fed when it comes to raising interest rates. But more important, I say that the Bank of Canada is more effective, not only vis-a-vis the Fed, but also vis-a-vis itself in the past. Between 87 and 90, interest rates in Canada went up by 650 basis points, gave birth to the 91 recession. Yeah, we all remember that. The housing market crash. We are now at 425. So less than the 650 that we have seen back then. No. If you adjust the 650 back then to today's debt level, it's equivalent to 300 basis points in today's language, which means that today 425 basis points is actually more of tightening than the one that led to the 91 recession. So that's why when I say I meet with the Bank of Canada, I said enough is enough. There is enough bad news in the pipelines, and this consumer is sensitive. The good news, the labor market and the consumer protecting us. That's a good thing, and that will lead to this wannabe recession. You overshoot in this environment, you take it to a real recession. That's more or less where we are, and that's what I'm fighting now with the Bank of Canada. But at the same time, two things might happen here. One, I hope, and that's my main case scenario, stop now, wait for a year and cut. The other, you panic because of inflation and you cannot blame them because of the reputation. Something happened with inflation and the rest to 5.5. Then we are basically in a recession in the second half of the year, and then they will have to cut much quicker. So you have two options. One is stay for a year and start cutting with a mild recession, wannabe recession, or a more significant recession due to overshooting and much faster cut in the second half of 2023. Those are the two options that we are seeing at this point.
I was reading on the weekend a report from the Economist magazine on their livable cities, where they create a modeling against income and housing prices, but also cultural education, healthcare, and other lifestyle factors. And interestingly enough, the perspective about Toronto was that we were the most livable city in North America at the moment. They measure crime rates and other factors, but their position was enormously positive. On the other hand, and one of the funny closing lines of the article was, you know, if you want the most livable city in North America to live in and one of those in the world, move to Toronto, and particularly with a 73-cent dollar. But the Foreign Buyers Act prohibits that for the next 2 years. So we have this kind of hanging over us. What's your opinion about those regulations?
I totally understand where the foreign investment ban comes. It's under this illusion that this is the contributor to higher prices. We know that foreign investment is a very small portion. At the margin, in some pockets, yes, I agree, but this is not the reason. But but there are some unintended consequences. Here I'm talking about the REITs. And that was something that we raised in the meeting in the dinner yesterday. REITs, every REIT in Canada now is basically a foreign entity. It's foreign entity and cannot invest because they have more than 3% foreign exposure. That's madness. That's not something that is in the spirit of this regulation. So they have to change it very, very quickly. And I think that there's a lot of pressure now to do it. So that's, I think, something that is totally nuts. REITs cannot invest in Canada because they are considered to be foreign entities because of their allocation of capital. That's madness.
Yeah, it's something that we have never experienced before. It's particularly for any of us who have looked at investments anywhere outside of Canada. It's generally been welcomed, and our whole spirit of investment in the country, particularly from students and those who are being educated here, and you want them to stay and be a contributor and be part of this community. And we're now telling them, we don't want you and we don't want your money. It's like totally antithetical to what we've been trying to do for many, many years. Okay, questions from the audience, Chris. I'm going to turn it back to you.
That's great. Thanks. And thanks again, Ben. It's great to see you. Lots of questions are coming in. Ben, I'm going to give you this first one. Can you provide an explanation of how housing is calculated in CPI in Canada versus the United States, and how that impacts the Bank of Canada's willingness to increase rates?
Yes, in the US, they measure it in a very simple way. They look at rent. And first of all, rent by renters and their rent inflation. That's simple. Then what about home owners? What about them? And they say, let's assume that you own the house, but you rent the house to yourself.
Mm-hmm.
That's a service provided by the house. So what is the cost? Market rent. And that's why rent is 40% of core CPI, because it's all about rent. In Canada, rent is only for renters. Then for home buyers, it's much more complicated. You look at the real estate commission, you look at the interest payments, and all kinds of other things. And that's why the share of housing CPI of housing in CPI in Canada is lower than in the US. In addition, it works in a different way because interest payments actually work to inflate inflation in Canada, while in the US that's not the case. So it's very complicated. So the focus is not on home prices. Home prices don't get into the CPI. It's a service provided by houses that gets into the CPI.
You know, speaking of rent, here's another one. I'll let either of you jump on this. Given rent increasing to record levels, which we've seen, the expected immigration, the lack of supply, especially with builders holding off projects, okay, when would the ideal time to buy a pre-construction rental condo be in Toronto? And are builders providing incentives? Andy, do you want to grab part of that and maybe Ben tack on, or the other way around?
Existing inventory available for sale of condos around 11,000 units. Anything that's on the market that's under construction as opposed to pre-con is providing significant incentives for a consumer to purchase today. These are generally subject to the market around you, and that's not too challenging to sort out where the dollar per square foot is. But when you think about real estate, think about it as a long-term investment, not a short-term commodity that can be flipped for this imaginary profit. If you're thinking of a long-term investment, any investment today is going to prove to be, by 2025, 2026, 2027, an excellent position for you for both equity appreciation and from a if an individual is looking at it as part of their retirement portfolio, for example. So, but think of it long term, and there's lots of opportunity for that. Pre-con, new construction product, which will be delivered in 28, 29, even 2030, will also be very good, subject to where it gets priced within its regional framework, and we expect we'll see that continuing along. And I mean, I think that the investor recognizes that and is continuing to be very resilient in this market. Our biggest challenge is getting them approved if you own multiple units and under the stress test. Over to you, Ben. Any comment on that?
Yeah, I agree. I think that the next few months, the next 6 months will be actually an opportunity to get into the market from a long-term perspective. I think that the market is not soft, but softer than it will be in the future. We know that the fundamentals are very, very strong. The market now is just adjusting to higher interest rates, low rise clearly adjusting, and even a high rise is still not where it can be potentially. Therefore, from a timing perspective, if you have a long-term horizon, not 2 years, not 1 year, but 5, 7 years, I think that the timing is good now in the next few months.
That's great. Connected, similar chain. Andy, this is coming from John Sorocklet. Hi, John. Thanks for the questions. Question for Andy and Ben. What is keeping high-rise condo market relatively stable right now? Is it price point?
I think the combination of supply that's very, very tight. Even when I say, 11,000 units, when we've been absorbing in the neighborhood of 20 to 25,000 units annually and higher, this is a reasonably tight supply. I think there's price sensitivity at the moment, certainly on new launches and incentive packaging on existing. So what's keeping it? What's keeping the absorption levels at least reasonably steady is a sense of this longer term opportunity, both from the investor or the end user. And it still remains the most affordable product that we're delivering within the marketplace in most regions. So those are the combination of factors. Ben?
Yeah, I absolutely agree. I think that it's the affordability aspect. It's the more affordable channel. The low rise is basically dead. So you have whatever energy left is going to the high rise. And I think that's the reason what we are seeing.
So John's was a two-part question, and it is this leads to it. With that, is there a price point threshold where sales will slow down? Like, for example, is it $1 million? Is that sort of like the mark in the sand where absorption will slow down and we'll start to see impact? Andy?
Oh gosh. John must have a project coming on. Right now, the overall MLS average, it's hard to deal in these numbers to be specific because you have to get to the region and the product type to be very specific. But the overall MLS average has shifted to 1,038,000. We weren't at this number. We were at this number in February of 2021. So that's 18 months ago, and or in fact almost 2 years ago. And we think that this overall average will probably slip to around the $1 million level, which will take us back into somewhere around 2020. Now that's all product and all mixes of all types. Household income still hovering around 140, but increasing at 5% to 6% annual. It's going to take I don't think we ever catch up actually, because by the time, as Ben's projection shows, 2025 as probably a pretty strong rebound, you'll begin to see prices elevating at that point in time, and income will never catch up. So you've got this, we're probably at if there's a bottom in the marketplace, we're very, very close to it. And if we're not there already, and as a number, overall, that $1 million mark is about where we're going to end up. Townhousing will be in the 800 to 850 range. Back to backs and stacks will be in the 7s and 650 even, and single family will hover around the $1.2 million, $1.3 million, and hold and stabilize within that range, depending upon region and product type.
There you go. Like we say, stay alive till 25. Two more questions, gentlemen. One on construction costs. Andy, we talk about the order book and, the importance of the order book and what we think may be happening. So the question is, and I'll combine two here. How can low-rise builders reduce pricing with so many fixed costs in the system? Are trades lowering their prices as the work declines? And then second part to that, similar from another attendee, do you anticipate a reduction in construction costs, both with goods and labor, as a result of where we are with the market today?
Ben, do you want to start that one?
Yeah, the short answer is yes, a little. I think that one of the reasons why we see more and more developers starting to test the water because labor is more available. So I think that construction costs will not go down dramatically, but they will stabilize. They will not be rising at 20% a year the way they did in the past 2 years. And that's good news. Will they be low enough? No, because trades are in short supply, as you all know, and that will not change in any significant way. So I think that that's an issue. And therefore, when we discuss things with governments, we basically say you have to do something about labor. You cannot put a number, which is 1.5 million units in 10 years, and then forget about it. You know, the maximum we can build is about 80 in Ontario.
I think
So you have to double that in order. So I think that labor will be easier. I think construction costs will stabilize, but I don't expect them to go down dramatically.
and it'll be different for low rise versus high rise. High rise is more buoyant, concrete, glass, and steel is going to have lesser impact, and low rise will be driven by, on material side, you know, drywall is priced really for the US market. So it'll depend as much on the US market where it goes. But I think the comment of Ben's right on, stable to slightly lower, but not significant. So what does a low rise builder do? It's going to have to be found in smaller product, different spec, tighter margin, and probably a land review. And in the shorter term, certainly 23 and into 24, there was pressure on the land value and the escalation of land prices that occurred through 21, 22, and that will where it will be found. Now, those are very difficult adjustments to do. It's not easy. It in some cases might be catastrophic, but that's where it'll come from.
And one thing that is getting very, very clear is that in order to achieve the 1.5 million target, which I think we will not achieve, but in order to get even close to that, labor will not be enough. You need, and you know, you can talk about changing the immigration system to get more labor, namely the point system, to focus on non-permanent residents, to focus on domestic residents, to change the shift to construction, all this business, fine. That will give you something, but will not take you to the target. The other part of the story is productivity, namely build differently. And you will see the government getting involved more and more in the private sector into innovation in real estate. The way we build factory-made houses, you know the story. I think we will see more and more of a push towards that.
And I think also one of the areas, two parts of where the province is heading and hopefully can coordinate this, but the approval process on average, from the time you buy a piece of dirt to the time you actually dig a hole, is 10 years. 10 years. So short time is money. Money doubles.
Yeah, absolutely.
A builder in a 5-year horizon. So the approval process, speeding that up is critical. Hence the debate on Greenbelt, which has, you know, been so exaggerated. It's critical to find the land that's available, that's currently adjacent to servicing, whether it's industrial or Greenbelt or otherwise, to improve supply immediately and dramatically. And the other is taxes. Maybe there's a coordinated effort. When Bill produced that report last year of taxes on a new home are now exceeding $200,000 a unit. Well, imagine if we were able to coordinate a program where we reduce that tax to produce more product in a 2-year horizon to $100,000. Like cut it in half arbitrarily. We've done it with zoning. Why can't we do it with taxes? So find a way to find the stimulus that gets passed on to the consumer that dramatically reduces prices. So there's ways to do it. It just is a coordinated level effort from all 3 levels of government, who are more gotten our way than they are helping in terms of the stimulus of this supply.
Good stuff. I'm mindful of the time, Ben. One final question, and then we'll do our draw. I'll just put this out. Either of you can grab it. Now that John Tory is no longer mayor, okay, well, we know the story behind that one on timing. Do you think this will affect Toronto real estate?
Well, he might be looking for a house. No, the policies in play are such that one mayor to the next, unless it were extreme left wing election, I think the policies in place are being driven as much by the province and coordinated efforts with the city that it will not have an effect, immediate effect. Longer term, who knows?
Good stuff. Gentlemen, thank you.
Ben won't comment.
I won't comment. Yeah.
You're the best, Ben. Thank you so much. You are just so insightful, and the sense of understanding of where our market goes is just second to none, and we really appreciate it.
A pleasure, and good luck with everything. It's going to be interesting in the next few months.
Thank you, sir.
See you soon. Bye-bye.
Ladies
Thanks,
and gentlemen, please stay on for our draw. If you are interested in becoming a sponsor of our program alongside Bental and CIBC Capital Markets, we welcome that. My email address is right down in the bottom there. You can reach me at chrism@pmabreather.com. Send me your ideas for upcoming episodes. If you'd like to become a panelist or speak to a topic or suggest a topic for Andy and the team to tackle, that's great. And if you're interested in sponsoring our little program, as we're in our 4th year, we welcome it. So thank you so much for everyone for your support. And out comes the house box, our first winner. Again, same drill as in previous years, 2 lunch gift certificates courtesy of CIBC. Our first winner is Manny Berhar. Manny, you'll get an email from CIBC with your gift certificate for lunch for next time when you're on the call. And then finally, the second winner is Richard Sachs from NMP. That wraps up our episode for today. Please join us in March, where we'll be having a very insightful and deep dive discussion. It will be surrounding the bill and the act now that is on the foreign buyers ban that we spoke a little bit here. We're going to have some industry professionals to speak to the issue, unpack it, talk about impact, as well as, this timeline. We got to get cracking on it, because 2 years, by the time we actually enact some action, it'll all be gone. So, ladies and gentlemen, thank you so much for your time today. We'll see you next time. Have a great day. Thank you.